Treasury yields declined today, taking back some of that momentum that they had to the upside yesterday after posting yields as high as 187. Well, we backed off to about 181. Part of that because of the headline risk that we saw today with the China deal or no deal. Part of it was because the market seemed to be a little bit top heavy yield wise. And lastly, we got a very strong 10-year auction. 10-year auction that came in at about 181. That's over 20 basis points higher than last month's auction. So if you liked them at around 160, you love them at 181. And that's sort of the mentality here. There was some good buying in as we were at the top of the yield range that we've seen for quite some time. So buyers did come back into the market. Doesn't mean that all is fixed and all is well. It just seemed like prices are much more attractive given the supply coming this week. And obviously the market has its doubts, I think, as to how really concrete any deal with China is, and that is really what's driving the market. And as we traded back down towards the middle of the range, that 165 to 185 range that we've been trading in, we trade back towards the center of that. Volatility remains low and subdued. It isn't going down anymore. We're back to that level we were at prior to the July 31st Fed cut. And that is kind of where the market is sitting. They aren't seeing 4% 10-year note yield volatility. It's not really seeing any major movement at this point. We're just kind of parked there. But we're not seeing any pushes up either. And there's been some pretty aggressive call buying, which is upside protection with the for any unforeseen event, risk, whatever it might be. We are seeing some aggressive call treasury buying, and that is obviously not being reflected in higher vol. So right now, volatility still remains subdued. Yields trading back into the middle of the range. And what do we have coming up? Well, really, the market we're getting economic data every day. We still get some lingering earnings reports. We get some, whatever we're hearing out of Washington and whatnot. But really, the main driver of the market is the China-U.S. trade. It's really what's propelling everything. And today we got a potential delay in the phase one, and that certainly didn't happen. But I think at this point the market is very knee-jerk reactionary, and that's why we saw equities come off their heights. That's why we saw treasuries sort of get a bid, and then we had a very strong auction, and that entailed keeping the market relatively bid. So at this point we're back heading towards the midpoint of the range, somewhere around 175, 177 will probably be where we'll park the market midweek. But at this point right now, momentum to the upside has slowed, so yields are not going higher anymore. Doesn't mean things won't change as soon as everything is great with China, but at this point the market seems very susceptible to headline risks, and we will continue to watch that despite the fact that we have economic data coming out every day and more Fed speakers talking about policy that doesn't seem to disturb the market or give the market any worries. Obviously, it's all about U.S. and China and getting that trade deal done sooner rather than later.